So what are the reasons for the stock split? Oh, sorry. What are the reasons? Because this is the work of the fund accounting team to check the discrepancies. So what are the reasons in which mismatches can come? That is the stock split can happen. That is the result of the corporate action. Commission differences, settlement date and trade date can be different. Holding mismatches, price mismatches, dividend declare and the MTM that we saw the open trade equity, that can be the mismatch of the unrealized profit or loss. Okay, and then we also saw the ethical. We were talking about the fundamental analysis in which we have to analyze the balance sheet, profit and loss, and cash balance. We will be going to the various ratios so that and then we also saw the weighted average WACC, weighted average outstanding shares, how to calculate it. So this is all about in brief. I will be just going to the analysis part in which we have to do some analysis work here. So we have saw the earning per share, that how it is getting calculated, that is the net income minus preferred dividend divided by the VASO, that is the weighted average share outstanding. Okay, and then we also saw the P ratio. See what happens is that the kind of jump we will see in the net profit, same amount of hike we should be always seeing in the price of this share. Suppose we don't know how much percentage it has gained. Let's make it a constant that profit is growing at a rate of 25% per year. Let's take this example, okay? Because we need a constant table so that as per that table we can make the price of the share constant. So the net income is 100 rupees and this is the profit which is growing at a rate of 25% per year. Okay, plus we will add the last year profit again. So this is the logic which I put. So next year the amount is 125. So it is growing at a rate of 25% per year. Okay, but as far as this is concerned, this is V3. So this will be V4 because in second year the profit has grown to 125. So we will see a constant rate of 25% growth. The same percentage rate of growth price should also show same or equivalent, because what happens is that this market is very, very fragile, transparent. Everything, whatever is happening, it will reflect in the share price. If considering all circumstances are same, so all keeping all situation in stable, so price should also grow in the same way. So if I will put this formula here, we'll see how much the price is growing at 25%. Okay, it will reflect here also same percentage. So as the stock price will go up, I just want to make it white. Okay, as the stock prices will go up at a rate of 25% per year in line with the profit, our P ratio will also go up. Okay, if if we will see for a year there is a drop down in the net profit, let's say 20%. Okay, we should also see a drop down in the price because it will reflect, because this is a market where it is. So as the net profit will be down, price to earning will be down. Price P ratio, that we will consider whether this is overvalued and undervalued, that we have some standard, that is we have learned about the industry PE. We will see which, that suppose this is in stock for the banking stock. Okay, so I hope I've shared this one with you. If not, yes, actually what has happened yesterday when I was showing you. Okay, so there was one paint document which I have made here, but I think I have not copied and sent to you. So we will be always, what is the value of the PE, when it is undervalued, when it is overvalued, we will just see. Okay, but the best standard is to match with the industry PE and the rate of growth that this stock is doing. presentations, IB. I hope it will be in module 3. We'll check. There is one slide also which you can always go and check. Okay, so it is the analysis, and I think daily volatility. I don't think this will be the link. Oh yeah, shit. Tape.in. Okay, it will give you the industry PE, and suppose for example you are doing research on ICICI Bank. Okay, see the first thing is that whenever we are doing an equity research, we always have to see from all parameters. Okay, so here it is in banking, it is a banking stock. It will if you will come down here, you will be able, it is you will be able to see the industry PE. Sector PE is 26.62 and this PE is 28.39. Okay, it means if the growth rate of ICICI Bank has to be known on which percentage the profit is growing. So we will come down and we have to analyze the balance sheet here, financials. Okay, on what percentage the profit is growing here. We can see the net income actually quarter to quarter basis or year to year basis. Okay, 2000, then 2019 was a slippage. Then see profit has grown by 100% here. This was the financials. We'll just check for the 2 years. And but it was half actually here. So it is net of it is 100% growth, 9 to the 18. So we can tell if it is P is more also it is more or less fair valued. But I can tell there is a lots of scope in this bank because the profit has grown by 100% here. But for the we cannot tell that every year it will grow in the same way. But we can take a base of 25% or 30%. If it will grow, it means the PE ratio is properly valued. Okay, and they always say that there should be some instance in which we should match. This is the sector P, overall sector P. Okay, so this is the the average PE of all the banks which is there into this sector. Okay, so this is just one of the comparison. See, some of the stock are there. You will go in Bajaj Finserv if you will see. Okay, this is a NBFC bank. You will see the NBFC bank sector. This is 26p. Okay, and this is I will tell Bajaj Finance is always overvalued actually because I am comparing with this sector P. Okay, this is 57 actually. But if you will see the kind of profits that it is generating, we can check that actually. What is the financials? Net income. I see it is because it deals with the cash, it gives loans on higher rate of interest. So it doesn't make it, I don't think it is a good buy, but it is always overvalued only. It will be always moving in because the people is also the also one rate plays here that is called favorite stocks into these streets. So whenever the good time comes, in the when we will say the good time is in the stock market when it is going down. So if you will tell me now, if the prices are touching at 13,000 rupees of Bajaj Finserv, that will be the, I think, the good entry to buy. That will be the good time where we can buy the Bajaj Finserv. See, if you will see, I don't see 10% is more than 10% up from last year profit. Though it is in profit, but if you will compare actually, 10 percentage, I think 20 percentage, yes. We can calculate actually. Okay, between this financial to this financials. And then we can see last year how much was the growth. Like that, we have to compare for at least 5 years. I'm just doing for 1 year for you. 1 divided by 3369. Yes, 32 percentage. 30% growth is there. It means more or less, if I will value it actually, it should be P should be at 30 or 40. 40 will be 35 will be fine actually, but it is, see, it is so much overvalued. But anytime you will see it is moving to in these P's only. Okay, what is the price you are paying for your 1 rupee of earning? So we'll just move to the book value per common share. Okay, what is the book value per common share? That is, the book value, the face value actually of the shares. It is having the face value and it is having the market value, which is trading at a premium. So face value is for the book value actually. Okay, book value. What is the actual value in the book? See, there is a, there they say if book value is less than the market price, it means it is, there is a link, and if the company is doing good actually, if the company is earning good profits here, okay, and if the book value is less than the market, it is fine actually, because the shares are always traded on a premium actually. Okay, always on a premium, but we want to know the undervalued stock in which the profits are doing good and the book value actually and the market price is less than the book value. It means book value is more than the market price. We will tell that is an undervalued stock where we can just buy actually. So if you will see all the large cap companies, their market price is more than the book because they are traded in a premium. People are paying premium for them. So how we have to calculate? That is the total shareholders equity minus preferred equity divided by total outstanding share. It is same actually. Weighted average will see total shareholder equity minus preferred equity, which I have given you example preferred equity and the preferred dividend and equity and the equal dividend. So this is the total shareholder equity which we have to calculate via assets minus liabilities. Okay, this is the formula. So keeping it a constant rate, that is if we will do this, TAC is constant for every year. Okay, and PE actually, PE has to move as per, if the prices will move up, then the PE will be high actually. Okay, if the prices, sometimes you will see that keeping all factors same, profit is also going up and company is going good, but the price is not moving. Okay, the price is less, and if the profit is going at 25% per year, we have to see the sector P. If it is growing at the same rate, then we will tell if the price is 70, it means it is undervalued. It means at least it have the capability to move to 10 rupees more. It means at least it can become double from here. That is also one of the reason where why people are taking P, because they will come to know the actual pricing of the share, whether this is the correct price or not price. Okay, so average in 15, some researchers will come and they will tell, oh, you should buy this stock. Okay, this is how it moves. So as the prices are going up, P is also going up. So as the P is going up, it will move the book value also. See, if the P is, I will keep constant P. As for example, this is only 10 P. Okay, so what is the book value? Book value is decreased actually. If the P is more, then it will increase the book value per share. Okay, so you will see book value, if it is P is becoming more, as for example 30, and then I will just increase 5 rupees in every of the tab. Okay, we'll see the effect. Okay, this is the preferred equity. Okay, total shares equity upon preferred equity. So we are touching the P. We shouldn't be touching the P. We have to touch the preferred equity. This is the preferred equity. Okay. So in this we have to touch the preferred equity. This is the logic that we have kept here. Suppose if the company is not giving preferred equity, okay, and if it is keeping it constant rate, we'll just see the logic here. I hope this is calculated. Sometimes it will also, go here and there. See, actually, this is, it should go there actually as per the formula, but it is touching here. This is not correct actually. See, total share equity, because we share with the students and they used to touch this thing. So please don't touch this, Ritesh. Okay, very careful. Total shareholder equity, this is the one, minus preferred equity. Okay, so it should touch that column actually, not this column. Okay, and okay, and divided by L3, that is the total outstanding shares. It will touch here. Okay, so I think now it will be fine. That is why I was saying that why there is no difference here. Okay, so this is the preferred equity. If the company will start giving preferred dividend, we'll see what is the effect on BP. Let's say 10. Okay, this is, it should be here and it should be here. Totally, they have changed the cells only actually. So this is what is preferred equity. Okay, we have to touch here, not there. And this should be here. See, this is the table. Okay, Ritesh. This is, like in the same way, like I'm doing, you have to practice it. Okay, I will, you can copy this whole table and you paste in your Excel. Okay, and there you do the practice because all these ratios are very, very important. Okay, and there is a logic that has been put over there. Okay, so as you will work in this table, you will see the logics are working fine. See, this is the preferred equity. So, you know what we have learned in the last class, I will take you. We have learned about the preferred shares. Okay, preferred shares, they are giving the preferred dividend, and for the equity, they are giving the dividend. Okay, so this is, they are talking about the preferred shares here, preferred equity, that is the shares only. Okay, this is not P actually. P is this one, P calculation, and this is the one actually. Okay, so keeping if they have not giving any preferred equity as such. Okay, so this divided by this minus this. Okay, I will just write again. I think some changes has happened here. Okay, divided by this one. Okay, this will do our work. Okay, so it is keeping everything constant, it will not change. Why? Because we have not touched this part actually. If keeping this will go up actually, suppose the asset have gone up and then the TAC is becoming more, 50 rupees we will do more. Okay, here 550 and 600. See, it has increased the book value per share. And if the company will start giving the preferred shares, suppose 10, we'll see the effect for this actually. 15 and 25, 30. Okay, so see there it has decreased actually. As the preferred equity will become more, the PVVS will decrease. Why it will decrease? See, this is the total shares. Okay, they have to divide this. You can take total shareholders equity. This they have to divide in the total number of shares. Okay. So giving you this example, if you have 10 rupees, 10 rupees you want to divide into 10 people. Okay, so this divided by this you will do, it means each person will get 1 rupees at least. Okay, if this share will become less, suppose you are giving some preferred, or you are giving some money to other person also. Suppose he is your friend and he has asked you some amount of money and you have given to him, suppose 2 rupees. It means this share will reduce. When this share will reduce, it will affect your distribution. It means now 8 rupees has to be divided among 10 people, so it will become less. Okay, so in the same way, as the preferred equity will become more, keeping all the figures on the same level for a total shareholders equity, we will see that the amount that they have to divide, it will become less. So this is the reason why PBVS is less. Understood or not understood, or should I explain you again, Ritesh?
Yeah, yes, understood.
Okay, so keeping all the things in constant. If suppose, for example, they will increase totals outstanding shares, okay, and if they will increase to 70, 80, then 90, then 100, you will see that PBVS will decrease, because if the shareholders will become more, then the distribution will be more into the number of people. So prior to this, if there are only 10 people who are eating this, who is enjoying these kind of, which the money which you have divided among them, now there are 15 people in which you have to divide this amount actually. So as per that, the profit per share or per person will decrease actually. Same logic is happening over here. Okay, so we will just touch this point, PV ratio, that is calculated on market price per share divided by the book value per share. So I will say if formula is correct or not. Market price, this is the current market price, and this is the price actually. It is the same actually which you have saw in EPS. EPS have to be calculated into the multiply times by the P ratio, and in the same way BPPS, book value per share, has to be calculated by PB ratio. Okay, so as the market price, if I will keep it constant actually, you will see the PB ratio have decreased actually here. Okay, so there is a link also. I will share a link with you for the analysis. Okay, so here in one nutshell, you can see all the financials of various companies. Suppose we were doing for the ICICI Bank. Okay, now we will see it there. Nowadays there is no need for you to calculate. Everything is automated. Okay, just you should know the logic actually. Okay, so we have saw the P ratio. You can also read more about it. Generally, high P is overvalued and low P is undervalued. But there is a reason behind it. Why it is undervalued? It will tell only yes or no. But if the company is doing good, okay, and the company P is low, then it is undervalued. If the P is less and the company is not doing good, then it is fine actually. It is worth if his P is less actually. Okay, so there is a clause for that you have learned over here. Just hold on. And this is the book value actually. Okay, it calculates the per share value of the company based on its equity available. Okay, so see, this is this, if you will analyze it properly, what is EPS? EPS, so there are various factors. Okay, there is called the net income. Okay, and there is called the total shareholders equity. there is a difference between them. Both of this is different. Okay. If our base is net income, then we will calculate on EPS, earning per share. Okay, and we will see whether it is undervalued or. If it is total shareholders equity, then we will come to know about the book value and we will come to know the PB ratio. Okay, so this is very easy because from your college time only, from school time only, we are learning this. What is total TAC? That is asset minus liabilities. So when you will divide, when you will subtract A minus L, your total shareholders equity will come from there. You can calculate the book value per share. Okay, so it is based on the TAC, total shareholders equity. That is the book value. Okay, and this is on the net income. Okay, it is the profit allocated to each outstanding share that is available. It is not the founders holding which we have saw in the TCS stock, promoters holding. So it is not based on that. Okay, and this is okay. So this is all what we have saw here. You can also serve this website. There is a automated value, it will be keep giving you, but first you should know how to calculate by yourself, and then you can go to the automated way. There is no issue. And this is the return on equity. See, company will company is having some equity worth. Equity is also based on the shares. Company will give shares, and company will allot shares, and company will collect money from people. Okay, that is we saw in the IPO market. So there is an equity that is getting involved. Okay, so what is the equity that they are putting, and how much is the rate of interest that they are earning? This is the ratio for this return on equity. It is calculated on net income. What is their net income and the shareholders equity? Okay, if suppose people have given company, if suppose company is coming with an IPO, okay, and company has collected 100 crores CR, it is in CR, mind you, okay, from the people. Okay, so if after 3 months, because nowadays company have to declare their net, they have to show their financial reports in every quarter. Yeah, every quarter they have to come and they have to show their financial reports. So suppose the company is earning 20 crores after 3 months. Okay, so this is the two base for them actually. That what they have earned divided by what they have collected from people, shareholders equity. What is the money that they have taken from the people? So this will be the base. If you will do into 100, it will the base for your return on equity. So this is the same actually. So as the net income will go up, it will affect the ROE also of the company. And if in some point of the time the shareholders equity will become more. Okay, suppose for example they are coming in course of time and they will raise more money, and they will raise more shares. It means there are more people with whom the money will be divided. Okay, and then the ROE will become less. So this is, we will see it is touching here net income. So keeping net income constant, suppose if TSE will become more, let's see. Okay, how it will impact the ROE. So if it is growing at 500, see, as the TSE is becoming more, the ROE is becoming less. Why? Because there are more people in which the money has to be distributed now. If the TSE is becoming more, and if the net income is also becoming more, then you will see now the change. Just see this table. Okay, whenever I'm doing any changes, see now as the net income is becoming more, and if the TSE will also going upwards, it is fine actually. This will increase the ROE. This will increase the ROE because the net income, because there is more money which has to be distributed, but it has to go via hand in hand. We say the net income should become more, and the TAC should, if it is becoming more, but not at the alarming rate of which the net income is increasing. So this is how the, they say this everything is interlinked actually. If the company will do any mistake here, if you will advise company to do any kind of, check, if without checking all the logics how it is working, if you will give any kind of advice, it can adverse your company actually, and it can go into the wrong way actually, in which it shouldn't be going. So always whenever the company or you are working in any department in which you are doing the, there are many departments. One is called the equity research department, in which if you are working, so you should always check the financials of the firm, only then you give your, what, suggestions to the company. Otherwise don't tell them anything, because it can go against you. Okay, so always check the financials and then do your equity research, then give your advice to your company. Okay, because situations can be anything, but everything should be on proper sheets, you calculate and then you tell. So this is how the return on capital. So company employs some capital whenever they are starting their businesses. Okay, so this is based on the earning before interest and tax. See, this calculation was based on the after the company has given tax. Okay, this is the EBITDA, earning before interest and tax. This is, we will calculate return on capital employed. Okay, so this is the total assets and this is the current liabilities. We have to calculate the capital employed. This is the total assets minus current liabilities. ROC, how we will calculate? EBITDA divided by the capital employed. Very easy. It is, there is no hiccups in this. Okay, very easy, you will understand. So only, you have to calculate the C in this. Okay, and then you only have to divide EBITDA divided by CE into 100. Okay, so again there is a logic out here actually. If your EBITDA is becoming more, okay, so this is a, you are dividing your CE. If you will see, this is the current liabilities and this is the capital employed. Okay, so divided by the capital employed. Okay, so if keeping this constant, if EBITDA is 30,000, this is also 30,000. You just check this figure actually. Okay, because the it is constant and capital employed is more actually. Okay, so your ROC is becoming less. See, if I will give you 1 lakh rupees, okay, and I will tell you, you do business. Okay, on 1 lakh rupees, if you will earn 10k, 10,000 rupees, it means you are earning 10% rate of return. Okay, if I will give you 50k, 52, and still you will earn 10k, 10k. Okay, here it means your capital employed is less, but you are earning the same profit. It means how much you have earned, how much percentage? 20%.
Yes.
Understood or not
Yes.
understood? Because your capital employed is less and your percentage. So here it is the same actually. Capital employed have increased, but net profit is the same. That is why ROC has decreased. With the capital employed, if it is becoming from 5,000 to 15,000, then it should also increase. EBITDA should increase actually. So if EBITDA is becoming 15,000, 50,000, then you will see ROC somewhat it will increase, but at least it should touch 1 lakh as per the capital, at least 1 lakh profit it should touch. Okay, then it will become fine. ROC will increase. So this is a small, part of the ratios which we have learned. Any issues in this? You have this short, just copy and paste and do your own analysis in this charts. Okay, I will be moving to the next chapter for the analysis part. We'll see what is the real and nominal. See, NAV calculation we have saw yesterday. Key ratios and balance sheet. See, whenever you want to read the balance sheet, always go on the primary source. Okay, Reliance. And go here. We can check the Reliance balance sheet in the Reliance website only. We will always take the primary source, not secondary source. Okay. We'll see this is the comparing consolidated balance sheet, how they are making. Okay, just a small quick recap. This is the non-current asset. See, these all we have learned in our 10th. Okay. So just you should read the way in which it has to be read. Okay, and then you will see the current assets. And there are inventories, financial assets, all blah 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 blah. And then there is a column for equity and liabilities. Okay, and this is the non-current liabilities. This is how the corporates are preparing their balance sheet when they are submitting actually. Okay, if you want to read it, I think there is a long version also which you can download and you can read. Consolidated turnover, consolidated net worth, consolidated EBITDA. See, whenever you are seeing any financials, you should know what ratio you can use. For EBITDA, we have learned just now actually that if we have the EBITDA values properly, we can calculate the ROC. Okay, so this is just a link actually. Okay, this is the turnover. Okay, fine. Whenever we will see the net profit, then we can calculate the P ratio. This is what your equity, when you will work in equity research department, then you will, you should, by seeing the things only, you should be able to tell what it is. Okay. This is, you are seeing the profit after tax. Okay. Net profit. It means you can calculate easily if you have all the financials and all the things in place, you can calculate the EPS and the P ratio for this. Okay. So this is also the earning per share, they calculate this. And they will do the comparative, study that how much it has gone up from the last year. So this tell it has increased 5.7% from the last year. See, this is earning per share calculated. This is how you can calculate. So this is just a metric actually. So by seeing the various kind of figures, you should be able to know that what ratio you can calculate. This is the way you will read, right? Just have a look on this. We will see what is the okay. So see, there are various things we have to consider. That is the, see, now we have saw the macro factor and the micro factor. We will divide into three parts: economy, industry, and the company. Okay, so we can make a chart also here where we can divide the financials and then we can see, because there are various factors which is getting affected. Okay, micro factor and the micro factor, macro and micro. This we have learned in economics also in, I think, 11th, 12th.
Yes.
Yes. So this is, economy, if I will tell, this is the macro.
Yes.
See, these we will divide actually, because, we will see the GDP growth rate, how the company is performing. Okay, how, in this, how the country will perform actually. How this is the some calculations, okay, of the various, finances which they are seeing, and then they were seeing whether the, and we are also seeing the sectorial analysis of the GDP. See, we can divide into various sectors, how these sectors are performing. Okay, how these sectors are performing in the GDP. We can divide into various sectors. And the foreign policies, inflation rate, unemployment rate, per capita and blah blah blah. You can just see all these things, economic sector, and then we will go to the industry wise. Okay, industry will see which kind of industry it is and the life cycle of the industry. There is a beautiful chart. I hope you have read this one. Also, life cycle of the industry. Okay, I will show you that. Okay, so this is the micro trends in which we will focus on the macro. We will see the economy, market timings, and balance portfolio. Okay, so this is when we are seeing the macro factors, we will follow the top-down approach. Okay, and when we are seeing the micro factor, we will follow the bottom-down approach. So, as per the factors that we are looking, this is the approach that we have to follow. Okay, so in this, if you will see the top-down approach, and this is the bottom-down approach. Same, chart you are seeing here, top-down investing and bottom-down investing. So this is we are placing economy as a first. How the economy is performing, we will see one by one for this. What is this and how it is affecting. Just meet me at 11:30. Okay.
Okay,
We'll
sir.
just quick break. Chalo, bye.
Bye.